This is Accounting 201. We're going to continue with Chapter 2, and now we're going to discuss recording business transactions. So this is starting on page 56 of your book. We're going to explain accounts as they relate to the accounting equation and describe common accounts. Define debits, credits, and normal account balances using double entry accounting and T accounts. Record transactions in a journal and post journal entries to the ledger. Prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. Use the debt ratio to evaluate business performance. So, accounting objective 2.1. So we're going to explain accounts as they relate to the accounting equation and describe common accounts. So what is an account? We have assets equal liabilities plus equity. The accounting equation contains three parts: assets, liabilities, and equity, and each part contains accounts. An account is the detailed record of all increases and decreases that have occurred in an account during a specific period. Here we have a listing of asset accounts. One thing that I recommend is to try to familiarize yourself with the different types of accounts and the different accounts that fall within those groupings. So for example, knowing that your asset accounts are cash, accounts receivable, notes receivable, prepaid expense, equipment, furniture, fixtures, building, land. Those are all asset accounts. Excuse me, bless me. And one thing to note is cash, obviously, cash is an asset. But then, some of these, they can be confusing if you're not familiar with accounting terms. So just kind of, if you see here, anything that says receivable more than likely is an account that's receivable, and therefore you are going to list that as an asset. So your receivables are assets, and your prepaids. So this one can be kind of confusing because people, they will see the word expense and they think, oh, that's an expense. That's not an asset. But if it's prepaid, then it is an asset. And we'll talk about that a little bit more. So prepaid, anything that's prepaid, asset. And then, of course, your assets, when you think of like personal assets as well, your house is an asset, your car is an asset. So equipment, furniture, fixtures, buildings, land, these are all assets as well. So the explanation: cash is a business's money and includes bank balances, bills, coins, checks, every form of cash that you have for the business is going to fall within that cash account. Note, accounts receivable is where a customer promises to pay in the future for services or goods sold. We saw this in chapter 1. So accounts receivable, we received, I think it was $500 worth of office supplies on account. So the company that we owed the money to, they have an account receivable waiting on us to pay them, right? So a customer's promise to pay in the future for services or goods, often described as on account. Notes receivable is a written promise. So just know, one of the key factors here with a note receivable is it is written. It's written down on a document or it's signed by both parties. It's a written promise that a customer will pay a fixed amount of money and interest by a certain date in the future. And it's usually more formal than an account receivable. Prepaid expense is a payment of an expense in advance. It is considered an asset because the prepayment provides a benefit in the future. So an example would be prepaid rent, prepaid insurance, and office supplies. So prepaid rent, let's say that the rent is due on the 1st of the month, but the company pays the rent on the 25th of the prior month. Well, if we pay our rent on the 25th of January and it's due on the 1st of February, then from January 25th to January 31st, that rent payment is prepaid rent. We paid it, but it was not yet due. It's not due until the 1st. So it's going to go into our prepaid rent account. And then on the 1st, when it's actually due, then we will move it out of our prepaid rent and into our rent expense account. So it was an asset when it was sitting in prepaid. But once we utilized that rent, that prepaid rent, it then became a rent expense. Equipment, furniture, and fixtures. This is the cost of equipment, furniture, and fixtures, such as light fixtures and shelving. A business has a separate asset account for each. The building is the cost of an office building, store, or warehouse, and land is the cost of land that a business uses in operation. Looking at liabilities, page 57. So we have accounts payable, notes payable, accrued liability, and unearned revenue. These are some liability accounts. Notice the word payable is normally in payable is a determination of liability accounts. So accounts payable is a promise made by the business to pay a debt in the future, and it arises from a credit purchase. Notes payable is a written promise made by the business to pay a debt, usually involving interest in the future. Accrued liability is an amount owed but not paid. A specific type of payable, such as taxes payable, rent payable, and salaries payable. And unearned revenue occurs when a company receives cash from a customer but has not provided the product or service, the promise to provide services or deliver goods in the future. Equity accounts. So we have common stock, dividends, revenues, and expenses. These all fall within our equity accounts. We saw that when we looked at the expanded accounting equation. So we're actually just going to talk a little more detailed about this. Common stock represents the net contributions of the stockholders in the business and increases equity. Dividends are distributions of cash or other assets to the stockholders, and it decreases equity. Revenues are earnings that result from delivering goods or services to customers, and they increase equity. Examples include service revenue and rent revenue. And then expenses are the cost of selling goods or services. Expenses decrease equity, and some examples include rent expense, salaries expense, and utilities expense. The chart of accounts. Chart of accounts is used to organize a company's accounts. A ledger is a record holding all the accounts of a business, changes in those accounts, and their balances. So here we're looking at the chart of accounts for Smart Touch Learning, and we see here we've got assets, liabilities, equity, revenues, and expenses. So just note, so here we're looking, we've got our balance sheet accounts listed on the top and our income statement accounts listed on the bottom. When we talked about the expanded accounting equation, we said that assets equal liabilities plus equity, and that in equity, note down here it says part of equity, within that equity account, we have revenues and expenses that also fall within equity. So this is showing us what a chart of accounts typically looks like for a company. I want to note a couple of things here. So we mentioned earlier as well that assets are supposed to be listed in order of liquidity, the most quick to convert to cash. So cash is always going to be listed first as your assets. So we see here our cash account is account 101. And then every other account that follows within our asset section starts with a 1. Liabilities start with 2, equity starts with 3, revenue 4, expenses 5. So just note that all of your accounts, they need within the type of account that it is needs to start with the same type of coding. So all of our assets are starting with 1. All of our liabilities start with 2, etc. And then in our asset accounts, we listed these by order of liquidity. So, for example, if we look at land, how quickly can we convert land into cash? It's probably going to take a minute, right? We have to list it for sale, we have to advertise it, it's going to probably be shown, and then eventually we'll find a buyer, and then that buyer may or may not be able to purchase it, and if they do purchase it, great. If they can't purchase it, then we have to find another buyer. So it can take a long time to convert land into cash. Same with a building, right? Same type of thing. It could take a long time. So that's why these are listed at the bottom, because they take longer normally to convert to cash. But we see here cash is already cash, it's at the top. And then we have accounts receivable, notes receivable, office supplies. So when we think of this, accounts receivable is money owed to us from like a customer. So typically our customers will pay us the day, within a few days of making their purchase or receiving their service. Maybe even within a week or 2. Sometimes 30 days, which is a month, right? When we have notes are written promises to pay. You can think of maybe like a loan or something like that. Typically notes have a longer time to be paid. So you might have someone sign a note, promise to pay within 3 months, 6 months, a year. So notes typically would take a little bit longer to convert to cash than accounts receivable. So that's why notes is listed under accounts receivable. And then office supplies, well, this is where we went and we bought a bunch of paper and pens and pencils and calculators, whatever, just a bunch of stuff, supplies for the office. Well, if we end up needing to convert that to cash and sell it, we have to find someone that'll buy it. And possibly even, it could even be used. Maybe we used some of it. So we have to find someone that will buy these office supplies. And so that can take some time. And then furniture, same thing. Furniture kind of falls within the office supplies or building and just trickles down. So notice that we have listed these in order of liquidity. It is normally, cash is always cash, and then it's normally quickest to convert accounts receivable into cash, then notes receivable, then office supplies, then furniture, then your buildings, and then your land. Liabilities are listed in payment order. And so we see here we've got accounts payable. We typically pay our payables, like the same with accounts receivables. We as a business typically pay our accounts payable more than likely within a week. Some may take longer. We may have special, terms set up and things like that. But normally accounts payable are on receipt or within a week. Salaries payable, we will pay our employees. Normally employee wages are weekly, bi-weekly, or monthly. Interest payable is normally paid either on a monthly, quarterly, or annual basis. Unearned revenue, notes payable, they differ, but so it is listed in order of payment frequency, I guess, where, this is the one that we would pay probably the quickest versus the least quick, because this more than likely has terms similar to the note receivable over here, where we don't have to pay this note for a year or 2 years or whatever the case may be. All right, so let's see here. So in your book on page 59, this is your in-class classwork. I need you to complete this and send it to me to get credit for it. So I want you to complete on page 59 the try it and send that to me for credit, please. All right, so objective 2.2, define debits, credits, and normal account balances using double entry accounting and T accounts. So what is double entry accounting? Transactions always involve at least two accounts. Accounting uses the double entry system to record the dual effects of each transaction. For example, you have office supplies and you have these office supplies, they're purchased for cash and they require an increase in office supplies and a decrease in cash. And then a shortened form of the ledger is called the T account. So we have the left side of the T account, which is the debit side. We have the right side of the T account, which is the credit side. And so here we're looking at the cash account. We have the debit on the left, the credit on the right. How do we record increases and decreases to an account? This is determined based on the account type, right? So this is where people kind of often get confused. So I just want to make sure that you understand this, because this is kind of hard to understand. So assets increase with a debit. So you increase cash with a debit. You decrease assets with a credit. Liabilities decrease with a debit and increase with a credit. And equity decreases with a debit and increases with a credit. So here we are increasing the cash account. If we want to increase the cash account, we're going to debit a cash account. So we've debited the cash account for $30,000, increasing it by $30,000. Here we are debiting the cash account by $20,000, taking the $20,000 out. Maybe we paid something for $20,000. This is very similar to our examples in Chapter 1, where we started with the owner. The owner contributed $30,000 cash into the business, so we debited cash for $30,000 to increase the cash account. And then there was a transaction of $20,000 for land, where the owner purchased land for $20,000, so cash decreased by $20,000, so we credited our cash account by $20,000 to decrease that. So the accounting equation is expanded to include the rules of debits and credits. So here we've expanded this out and we're showing the T accounts and the rules, how the debits and credits flow. This is a really good slide for you, slide 16, to definitely review, use, check. I mean, it's definitely a good slide for you to come back and review. So assets increase with a debit, decrease with a credit. Liabilities decrease with a debit and increase with a credit. Owner's capital decreases with a debit, increases with a credit. Owner withdrawals increase with a debit and decrease with a credit. Revenues decrease with a debit and increase with a credit. Expenses increase with a debit and decrease with a credit. We are going to watch a little video right now, and I just want to make sure this is a really good video. Again, if you're watching this video later, you're not going to be able to see the video. So definitely pull this back up if you need to take a look. All right, here we go. Oops, sorry. All right. Give me just 1 second here. Just drafting your. Here we go. Perfect. Okay. So I really hope that that helped. Again, I hope that if you if you do view this outside class, that you are able to go in and pull this up on the screen. All right, so normal balance. The normal balance. What in the world is a normal balance? So all accounts are summarized on one side of the T account called the normal balance. So this is the side that the normal balance falls on. So normally when you think of your bank account, hopefully the normal balance in your bank account is a positive balance, showing that you have money in your bank account. So the normal balance in your bank account is normally a positive balance, meaning that you have a positive number. Do not think of debits and credits as your bank account, but this is just an example of normal balance. So the normal balance is what is normal for that type of account, right? So when we look at the T accounts, remember a couple slides back, we talked about how assets increase with a debit, decrease with a credit, liabilities decrease with a debit, increase with a credit. So when we talk about normal balance, we're saying, is the normal balance of the asset account on the left side, the debit side, or is the normal balance on the right side, the credit side? And the normal balance for an asset account is going to be on the debit side, because that's how we increase our assets. So when we think of cash, cash is an asset. We increase cash by debiting the asset account. So assets increase with a debit. So the normal balance is a debit. And then liabilities and equity increase with a credit. So the normal balance is a credit. This is a great slide to come back to and refer to, slide 19. Definitely come back to this slide. It shows you what the normal balances are. These can be a little confusing at first because you may not be familiar with it. Some people will get confused with debits and credits, increases and decreases. So definitely refer back to this slide, but assets increase with a debit, decrease with a credit. The normal balance is a debit. Expenses increase with a debit, decrease with a credit. Normal balance is a debit. Dividends increase with a debit, decrease with a credit. Normal balance is a debit. Liabilities increase with a credit, decrease with a debit. Normal balance is a credit. Revenues increase with a credit, decrease with a debit, and the normal balance is a credit. Common stock increases with a credit, decreases with a debit. Normal balance is a credit. Alrighty, this is a really good one too. So here's another video, and in this video, we talk about the normal balance of an account. right. I hope that was beneficial. All right. So there is a try it on page 63 that I want you to work on. And then I want you to send me your answers. Page 63, try it. This is for in-class participation. This is part of your in-class assignments. All right. So determining the T account, use the T account to determine the ending balance in an account. The ending balance is shown on the side with the larger number. All right, so here we go. We're looking at our cash account. We see here we've got a debit of $30,000, another debit of $5,500. Those total to, well, and then we have some credits. We've got a credit of $20,000 and a credit of $3,200. So we've got total debits of $35,500, total credits of $23,200. And when we combine those, the balance that is in our cash account currently is $12,300, and that is on the left debit side of the account because that side is the larger side, right? When we add these together, we're left with $35,500 over here, $23,200 over there. When we find the difference of the two, the larger number is on the left, so the balance is going to go on the left-hand side, which is the $12,300 debit. All right, and then we've got that tried on page 63 that I mentioned. So make sure you complete that. All right, so objective 2.3, record transactions in a journal and post journal entries to the ledger. How do you record transactions? Accountants use source documents to provide evidence and data for recording transactions. The documents help businesses determine how to record the transactions. So source documents, the origin of the transactions. We're looking here at the flow of accounting data. So first, a transaction occurs, then source documents are prepared, invoices, packing lists, POs, all sorts of different types of source documents can be created. But source documents are prepared, and then the transaction is analyzed. Okay, we're looking at this transaction. Does this make sense? Does this, is this legit? Do we have all the proper documentation for this transaction? And then the transaction is journalized and posted onto our ledger within our accounting system, however we track our accounting data. Other source documents that can be used are purchase inventories, bank checks, sales invoices. When we journalize and post transactions, so after reviewing the source documents, accountants record the transactions. Transactions are recorded in a journal. A journal is the record of the transactions in date order. And this transfers data from the journal to the ledger, which is called posting. We're going to run through a couple of example transactions here. So on transaction 1, stockholder contribution, on November 1st, e-learning company received $30,000 cash from Sheena Bright. She gave us $30,000 to invest in the company, and the business issued capital to her. We recall this from chapter 1. So when that happened, we debited our asset account because cash is an asset and it increases with a debit. So we debited our asset account for $30,000. We credited our common stock account for $30,000, showing that the equity increased. When we journalize this transaction, we are going to go in, we're going to put the date of the transaction, the date that it occurred. In this example, it was November 1st. We're going to put the accounts that were involved. So our cash account, our common stock account. Our cash account was debited, common stock account was credited. And then we're going to put a brief explanation down here explaining what happened within this journal entry. In this case, we issued common stock. This is important because, even if you could be just a business owner or an accountant, whatever the case may be, but no matter what position you hold in the business, if you are having to record transactions, if you get audited later on down the road or anything like that, or let's say that someone else comes in after you, or let's say that you are in this position and then you move up and you have someone new come in to take over the position that you held. You know, things happen. Sometimes, guys, sometimes I don't remember what I did last week. So, you know, putting a note in here to kind of explain what's going on with that transaction can be very beneficial. It can help to explain the situation to others. It can reduce the number of questions you may receive regarding the transaction because you've already explained it in your documentation. And it can also help to jog your memory as well, because you may forget, well, I don't know, why did I issue 30,000 common stock on November 1st of last year? I have no clue. Now you've got to do research, and that's time that you did not necessarily have to spend, right? If you would have just taken a few more minutes to add a note, a brief explanation, you could potentially save yourself hours of time later on down the road. And other people that time as well, because time is money. Time is valuable. Do what you can now to reduce it later. Be more efficient. So add that little note there, that explanation of what's going on. And then number 3, credit account, the credit account name and dollar amount. You credit the account name. It's indented, notice here. So the debited accounts are listed first, and then when we list out our credited accounts, there's an indentation just to distinguish between the two to make it easier for viewing, easier to distinguish between. And so then we're bringing that down into our T accounts, okay? So this is our journal entry, and now we're bringing our numbers down to our T accounts. So our cash T account was debited on November 1st for $30,000. Common stock T account was credited on November 31st for $30,000. Notice that this transaction occurred on the left-hand side here and on the right-hand side there. So our books will still balance. And then on November 2nd, Smart Touch Learning paid $20,000 cash for land. All right, so when we bought that land on November 2nd, we debited our land and we credited cash. And we're going to put a note in here that says that we paid cash for land. And then we bought those office supplies. We paid $500. We bought $500 worth of office supplies, but we purchased them on account, so we haven't paid anything yet. So we're going to have to come in. We're going to create a journal entry to an account payable account because we owe that money. So we're going to debit our office supplies asset account. We're going to credit our accounts payable account, and we're going to note that we purchased office supplies on account. All right, and then we've got on November 8th, Smart Touch Learning collected $5,500 for service revenue, and the business earned that by providing services for customers. So we are going to go in and we're going to debit our cash account for the $5,500. We're going to credit our service revenue account for the same amount, and we're going to note that we performed services and received cash. And then on November 10th, Smart Touch Learning performed services for clients, for which the clients will pay the company later. So they're going to pay us later. All right. So we're going to debit our accounts receivable, credit our service revenue, and we're going to note that we performed services on account. In transaction 6, Smart Touch Learning paid cash expenses on November 15th of $2,000 for office rent and employee salaries of $1,200. So in this journal entry, we're debiting our rent expense of $2,000, salaries expense of $1,200, and we're going to credit our cash account for $3,200. And in our note, we're going to note that we paid cash expenses. And note that a journal entry with more than 2 accounts is called a compound journal entry. And then on November 21st, Smart Touch Learning paid $300 on the accounts payable created in transaction 3. So now we've made a payment on that purchase that we made on account. So we're going to debit accounts payable, credit cash, and note that we paid cash on account. In transaction 8, we collected $2,000 cash from a client. So someone owed us some money. We collected that cash, so we're going to debit our cash account for $2,000, credit our accounts receivable for $2,000, and we're going to note that we received cash on account. On November 25th, a payment of $5,000 cash was paid for dividends. We're going to debit dividends for $5,000, credit cash for $5,000, and note that we paid dividends. On December 1st, we prepaid 3 months of office rent for $3,000. So we're going to debit our prepaid rent for $3,000. We're going to credit cash for $3,000, and our note is that we paid rent in advance. On December 1st, we paid employee salaries of $1,200. So we're going to debit salaries expense for $1,200, credit cash for $1,200, and note that we paid salaries. On December 1st, we purchased a $60,000 building in exchange for a note payable. So we're going to debit building, credit notes payable, and we're going to put in our explanation that we purchased a building with a note. On December 2nd, Smart Touch Learning received a contribution of furniture with a fair market value of $18,000 from Sheena Bray. So we're going to debit our furniture account for $18,000. We're going to credit our common stock for $18,000. And we're going to note that we had a contribution of furniture in exchange for common stock. On December 15th, Smart Touch Learning received a telephone bill for $100, and we're going to pay this expense next month. So we're going to debit our utilities expense for $100. We're going to credit utilities payable for $100, and we're going to note that we had accrued utility liability. On December 15th, Smart Touch Learning paid employee salaries of $1,200. So we're going to debit our salaries expense for $1,200 and credit our cash for $1,200. We're going to note that we paid salaries. On December 21st, a law firm engaged Smart Touch Learning to provide e-learning services and agreed to pay $600 in advance. We're going to debit cash, credit unearned revenue, and we're noting that we collected cash for future services. On December 28th, Smart Touch Learning collected cash of $8,000 for service revenue that the business earned by providing e-learning services for clients. So we are debiting our cash account. We're crediting our service revenue account. And we're going to note that we performed services and received cash. All right. So on page 76, this shows you a complete listing of all of the different entries that we have made. So if you want to see all of those entries in one location, Those are located on page 76. Now the ledger accounts after posting. So 2.7, where it's showing everything on page 76, shows that all the accounts after the posting journal entries in November and December, we're going to notice that the total assets of 114,700 equals the total liabilities of 60,900 plus equity of 53,800. So our total liabilities plus our equity also equal the 114,700. So both our assets and our liabilities and equity all equal, which is what we want. That means everything balances. The ledger reports the ending balances in the asset accounts after the journal entries are posted. And so here, we're actually looking at that page now in our slides. This is page 76 in our book. So this is just showing all of those accounts. Go over one. We've got here our T account versus 4-column accounts. This is the 4-column T account, 4-column. So we've got the debit or credit for each transaction is listed here. The balance of the account after the transaction is listed here. So we've got the date, the item, the posting reference, the debit, the credit, and then the balance in the account at the end is that a balance that is debit balance or is it a credit balance? And then over one more page, so posting references. Posting references are the page number from the journal, okay? And then the account number from the journal is listed here. So we've got the page, we've got the account number, and then we've got our posting reference. So right here, we're looking at J1. J1. On page 79, we do have, I'm sorry, it's on page 78. Let's just look at one thing. We are going to skip that one, so do try it on 78. I'm going to skip that. All right, learning objective 2.4. Prepare the trial balance and illustrate how to use the trial balance to prepare financial statements. So in working on your assessment, you are going to be preparing a trial balance. So you need to know how to do this. You're preparing a trial balance, income statements, retained earnings, balance sheet, statement of cash flows. So you need to know how to do this. All right. So what is a trial balance? A trial balance is a list of the ledger accounts with their balances at a point in time. The asset accounts are listed first, followed by liabilities, and then equity. So here we've got a listing. This is our trial balance. And if you look here, we have got a listing of all of our accounts. All of our accounts are listed here. So we're looking at, so we've got our cash account, our accounts receivable account. We've got our office supplies, prepaid rent. So we've got all of our asset accounts listed at the top. Notice that. And then after your asset accounts, then you're going to have liabilities as well, your revenues, your expenses. They're all listed below. And then the trial balance and the balance sheet are not the same. So make sure that you remember they are not the same, okay? Trial balance and the balance sheet are not the same. Make sure you understand the differences between these two documents. The trial balance verifies the equality of debits and credits. So our debits should equal our credits, and the trial balance verifies that they do equal. This is an internal document used only by employees of the company. No one outside of the business uses the trial balance, but it is still important. We still create it, we still analyze it, we still use it, because we have to know, we have to make sure that our debits equal our credits, right? We have to make sure. If they don't, then we messed up somewhere, which means that, I mean, that could be a big deal, okay? Because that means that maybe we put something in the debit column that should be a credit, or in the credit column that should be a debit. Maybe it's more than one item. We don't know. We got to figure that out. All right. So this helps us to quickly identify that there, if there is an issue, that there is one, so that we can go in and try to fix that. And then the balance sheet, on the other hand, presents the business's accounting equation and is a financial statement that can be used by both internal and external users. So the balance sheet is used by both. All right, and then so here we are looking, we have got we're looking at our income statement, our statement of owner's equity, and our balance sheet. Our income statement shows our revenues, our expenses. We take revenues minus expenses, which gives us our net income. On our statement of owner's equity, we have our owner's capital, owner's contribution. The net income is brought over, right? Pay attention to that, because when you're working on your assessment, you need to remember that your net income is going to be brought over from your income statement. So if your income statement is wrong, your statement of owner's equity is going to be wrong. And then when you bring over this right capital from your owner's equity, it's going to come here to your balance sheet, and if your equity is wrong, your balance sheet is going to be wrong, which means you're going to have 3 zeros on your assessment because they are wrong. So make sure that you pay very close attention to how to create these and calculate these and form these. I mean, there's tons of examples in your book. We're talking about it now. There's tons of examples in your book as well. Go back and use these slides. Refer to these slides when creating these, because it pretty much lays out exactly what you need to do in your book and in your slides. You just have to look at it and read it. Do the research. It's there. Because if you get one of these wrong, incorrect, you will be incorrect on all of these. And the assessment is a very big part of your grade. So you don't want to get these wrong. Alrighty, and then we do have on page 81, there is a try it that I need you to do to complete for credit. And this try it on page 81, try it number 22, is also a very good example of what you have to do for your assessment. So definitely work on this try it. Send me your try it once you've completed it, so you can get credit for completing it. And that is the third in-class assignment that I've assigned so far for chapter 2. All right, so correcting trial balance errors. When we search, we need to search for missing accounts or errors. And, you know, if there is an error, we have to fix it. So one way that we can identify those errors is to divide the difference between our debits and our credits by 2. If we divide that difference by 2, a lot of times we are able to then identify the amount. As long as it's only one account that's out of balance, we can easily identify that account based on the dividing by 2. A debit treated as a credit or vice versa will double the error. So if we have a misplaced account, a misplaced debit or credit, we credited when we were supposed to debit, then when we divide by 2, it will identify the amount of that, and we can go in and we can locate it and change it. But that doesn't always work, right? Because we have multiple items that are being mislabeled and stuff like that. Then there's a little bit more involved, more in depth, and it can get pretty gruesome. So we want to make sure that we are identifying everything correctly the first time. Divide the out of balance amount by 9 to find any transposition errors. So if there is an amount that's out of balance and you divide it by 9, a lot of times it will identify certain amounts that may be transposition errors, meaning that you mistyped something and it's causing, you know, something to be out of balance. All right, and then use the debt ratio to evaluate business performance. This is also part of your assessment. Pay attention. So the debt ratio shows the proportion of assets that are financed with debt. It can be used to evaluate a business's ability to pay its debts and to determine if the company has too much debt to be considered financially healthy. The debt ratio equals total liabilities divided by total assets. Total liabilities divided by total assets equals our debt ratio. So it is important to know how to perform this. It is part of your assessment. And then your last final problem, problem number 4 in chapter 2 that I need you to complete and send to me, is on page 82, try it number 23. And this is also something that you will find on your assessment. So definitely do this, try it on page 82. Send it to me so that I can make sure you're on the right track for your assessment as well. So that is a total of 4 in-class problems for chapter 2. So we're going to work on, so right now we're going to work on page 59. We're going to work on those 4 in-class problems that I have assigned to you throughout this class. So let's work on those problems, send those to me. And I also have a couple of problems here. You see the slides. I can't show these again on our video, so I am going to stop recording. But I have a couple of in-class problems here that I want to work with you guys as well that are very similar to what you're going to see on your quiz.